Okay. So this is the paper that came in 2022. It was interesting that they were writing it in the afternoons from 14 to 17. It was not hot. It was cold because it was in July. Then, so this is the data that we have just been given. And I do still think that question number 1 is just a little bit related to what we were discussing last time. Yeah, this part of the question was already discussed previously. So I am intending to skip question number 1. What do you think? Like it's the same one that came in those assignment. Like what is that? The online test, like the one that we did in the previous conversation. These are the same questions. So I'm thinking about skipping them a bit so that we talk about maybe something different. How does that sound? We can't keep recording the same thing again and again.
That's fine, sir.
I mean, question number 1. These are same things. Burma increase market share. What? Like, didn't we talk about? They are the same things. Like we talked about this in the last class we had, and it was recorded. I shared in the group again. So I don't know. I'm not of the idea that we keep on recording the same thing again and again. Unless otherwise.
We can skip it, sir.
Yeah, let's try to skip this one. Let's try to skip this question. Go through the same recording that we had in the last meeting. We talked about these same questions. If they still give you pressure, you can still get the phone and find out. Like we are still there to answer, just to amplify those parts that you may not understand. Yeah. Similar question number 2 as well is just like assignment number 3 that you just did previously. I wanted us to speak about question number, this one for financial statement analysis, because it's been a long time since we talked about something similar to this. And the question has not come in the way how it came, that one. This one looks a little bit different. That's what I wanted to comment on. If it is fair, then we can head that same direction in the meantime. Right. So this is the data that was given for the year 2018 and 2017. And so the required is to use the information above to calculate the following ratios, to calculate the financial ratios and make relevant comments. You are to make relevant comments. Yeah. You don't run away from this conversation, please. It's very, very important that you be in class, because financial statements analysis is something that you cannot just guess. You need to understand the mechanism. Okay, so you're supposed to calculate the profit and profit margin, the return on capital. Yeah, that is very important. Okay. Now, let's start with the profit margin. How do you calculate the profit margin? How do you calculate the profit margin? And so there are two profit margin. There is net profit margin, a gross profit margin, operating profit margin. So they have just said you have to calculate the profit margin. I am of the idea that you can easily calculate the gross profit margin by calculating for the profits for each year. Okay. Let's calculate the gross profit margin. How do we find the gross profit margin? The gross profit margin is found by finding the gross profit divided by revenue or sales, then times 100. If you don't have sales, you have revenue, you write revenue as the denominator. The GP is the gross profit. Gross profit over revenue times 100. That is very important. Write the formulas in full. Okay, so in the data that we have been given, we have not been given the gross profit, but we can easily calculate for it, because to find the gross profit, you just say revenue minus what? Cost of sales. Is that clear? Revenue minus cost of sales, that gives us the gross profit. Okay, what is our revenue? These amounts are already in millions, so we can just be. Let's start for 2017. We start with for 2017, it will be 68,000 less the cost of sales being 25,772. So what is the gross profit? Let's get the gross profit. $68,000 minus the cost of sales being 25,772.
42,228.
Is what?
42,228.
Okay. 42,228. Did you say so?
Yes, sir.
Okay. That's a gross profit for 2017. Let's do the gross profit for 2018 in the similar manner. You say 74521 being revenue, then you less the cost of sales being 28,256. What's the difference?
$45,995.
Sorry?
45,995.
95, like this.
Yes.
Okay. So we have found the gross profits. Then we can easily now go ahead and calculate the gross profit margin. So let's go ahead and do the gross profit margin for both of the years. What about 20? Let's start with 2017. What did you say the gross profit was? It was 20 what?
So for 2017, 42,228.
Oh, 42,228, like this.
Yes.
Divided by the revenue being 68,000, and you multiply by 100. That gives you the gross profit margin for 2017. Okay, and what is the gross profit margin? Someone to be calculating also for 2018, the gross profit margin. What was the gross profit? Was 45 what? 995, like this.
For 2017, 62%.
Sorry?
62%.
62%, the gross profit margin. What about for 2018?
To two.
It is 62 still.
Actually, 61.7%.
But when you round it off to a whole number, it's still 62%, right?
Yes.
Oh, okay. That's about the gross profit margins. So you can see that the gross profit margins were still the same. They are still the same. Like they were the same. So the comment would be the company maintained the profitability level according to the gross profit margin. The company maintained its profitability level according to the gross profit margin. It stood at 62% in 2017 and also in 2018. Did you get that? Interpretations, you can use the same words, your own words, as long as you stick to the principles and the information that you are saying is acceptable, let's say. So you can see that because the gross profit margin measures the level of profitability of a company. Yeah, it's one of the measures that we use. So expressing the gross profit as a ratio of the sales or revenue, the company maintained the level of what profitability, 62%, both in 2017 and 2018. Is that clear?
Clear, sir.
The other ratio that we are supposed to calculate is the ROS. The ROS. Now, what does the ROS mean? The ROS is return on capital employed. Return on capital employed. So return on capital employed. So how do you find ROS? What did we say the formula is for finding ROS? So the ROS is, yes, sir.
We said it's profit before tax and interest over total capital.
Okay. Right. So PBIT, profit before interest and tax, right? We are looking for the profit before interest and tax divided by the total what? The total capital employed. The total capital employed. So let's go ahead and define the PBIT. What is the PBIT for 2017? Profit before interest and tax.
It is 13,506.
13,506. 0.
That
like
is
this?
506. No, 506.
Or 506.
Yes.
Divided by, that was for 2017. Divided by the capital employed. So what is our capital employed? 2017. What is the capital employed 2017?
It is 35,087 plus 17,500.
Plus 17,500.
500.
35,000 and 87 plus 17,500. Someone is asking, why are we adding plus 17,500? So where did you find the 17,035? So it's the shareholders funds, okay? Shareholders funds plus long-term debt. Those, they form total capital. Is that clear? Like shareholders funds and the long-term debt, they form total capital. Okay. You can add together, you can do the divisions and give us the solutions.
It's 25% 0.68.
25% 0.68. Let's say it's 26%. That's for 2017.
Yes,
What
sir.
about for 2018? Shareholders funds. We need the first, we need the PBI, profit before interest and tax, being 14,749 divided by what? Yes. Divided by the capital, the shareholders funds, equal 39,900 plus 14,000, which is the long-term debt, times 100.
It's 27.4%.
27.4%. Okay. How would you interpret this one? So now, look, the return on equity does measure, okay? It measures, or it shows us the operating profit that is generated from every amount of asset employed. Or in other words, it is communicating to the investors how much profit each quarter they invested, okay, of capital generates. So usually the higher the ROS, even the better, okay? The higher the ROS, even the better. So for this company, you can see that the return on capital employed increased in the year 2018, okay? It increased from 26% to 27.4%, indicating an increase in the profits generated from the capital employed by the company. Does that help? So it showed the increase in the profit generated by the company. So there was an increase. Okay. Is there any question? People have a question? No question. Okay. Okay, so let's go to the quick assets ratio. How do we find the current asset ratio? How do you find the current asset ratio?
It is the current asset over current liability.
Right. The current assets over current what? Liabilities. Current assets over current liabilities. Current assets over current liabilities. So what's the current asset? (2017).
It was 19,700.
19,700. 2017. And as a current assets or current liabilities. Okay, that's those current assets. Okay. Then current liabilities, 8,600. So what was the ratio? How many times does the liabilities get into assets?
$2.3.
So it was 2.3 to 1. That's for 2017. What about for 2018? For 2018. So the current liability, the current assets equal 20,000. So that the current liabilities can be 9,500. And when you divide that into that, what do we get?
$2.1.
2.1 to 1. Was this an increase or a decrease in profitability? Or sorry, in liquidity? Current assets ratio measures the level of liquidity of a company. Okay. Hello? How would you interpret this in terms of liquidity? Yes, sir.
I think it maintains since it's going in twice.
Sorry?
I'm saying in both years, it's going in twice, so it's maintained.
Yeah. The level of profitability, sorry, not profitability, level of liquidity of a company was still the same. And again, the general comment we can pass about the liquidity, the company is still okay because the current assets, okay? The current assets it has are still enough to do what? To meet the current liabilities. The current liabilities enters twice into the current assets, which means the company is still okay. Is that clear? Hello? Because it poses a danger, there is a danger when the ratio is less than 1.5. That shows that there is low level of liquidity in the company. As a result, the company may not be able to meet some current liabilities and is in danger of running into insolvency. Okay. You're also asked to find the quick ratio. How do you find the quick ratio? How do you find the quick ratio?
We remove the inventory this time. Current asset minus current liability minus inventory.
Okay. Current asset minus inventory divided by the current liabilities. We start with 2017. The current assets, they are adding up to how much? $19,700 minus the inventory. Being 7,900. Right. Divided by the liabilities.
It's 3,100, sir, inventory.
Oh, it's 3,000. The inventory is 3,100. Okay. 3,100. Then the current liabilities, 79, right? No. Current liabilities for 2017.
8,600, sir.
8,600. Okay. So what is the ratio?
1.9 to 1.
1.9 to 1. Okay. This is still okay. What about for 2018? Let's do for 2018 now. So it was 20,000 current assets minus
3,000.
3,000 divided by how much?
$95.
And so what is the ratio?
1.8 to 1.
1.8 to 1. What would you say about the level of liquidity? What would you say about the level of liquidity?
It's in the same range, sir.
It is still within the same range, but at least it decreased. There was a slight decrease, right? Just a slight one of 0 point something. But it's still within the same range and it's still okay because the benchmark is 1-to-1 for quick ratio. It is 1-to-1. So if it is 1-to-1, then it means that the company is still okay. But you can see this one is even above the benchmark. So the company is still having enough what? Enough of liquidity. Is that clear? We said the reason as to why we remove the inventory, we remove the inventory so that you can remove the assets that are not liquid. Okay, because the inventories are less liquid because you'll need to sell them, and after selling them, that's when they can convert it into cash. So they are not highly liquid. They are less liquid. Is that clear?
It's clear, sir.
You are also asked to mention the receivables, period. To calculate the receivables period. How do you find the receivables period? You have been going through these. What is the formula? What formula do we use to find the receivables period? The receivables period. How do we find the receivables period?
Average receivables divided by sales times 365.
Average receivables over the credit sale or just sale, which
Times
is the same as the
365.
revenue, times
Yes, sales. The sales will be
365. Right. What about the receivables? 2017.
7,900.
7,900. And the revenue is 68,000. All that multiplied by 365 days. So that can equal to how much? To how many days?
Sir, isn't the receivable 16,300?
Which one now is which? I think the receivables should be 16,300. How do you know? Yes, should be 16,300. Now the problem is that here on the computer they look joint, but I think on the hard copy you can easily see them properly. Okay. How many days are these?
$84. 87 days.
87 days. Wow. Thank you. 87 days. How do you interpret now that? What could be the interpretation of the same?
We're not supposed to compare it to 2018.
No, I mean
That is,
just on its own. What
on its own,
information
it's
that
not okay.
what
Because
does it measure? No, like what
it
does it
means
measure? I want the meaning of the ratio, like the ratio itself. What does it mean?
It measures
it means
the
that
the
they are
time for the debtors to pay us.
Okay, Mr. Stanley, go ahead, then he will come in. What did you say?
I said the ratio measures the period which it takes for debtors to pay us.
Okay,
So in this sense, it's taking about 87 days for debtors to pay us.
all right. Thank you for that one. Mr. Shakasunga, you have a different one?
it's the same.
Okay. So on average, it gives us that range, about 87 days. Can you manage to calculate for the other year?
For 2018, it's 75.9, which is the same as 76 days.
87 days. Here, then here it was 75 days.
6 days, 75.9, which is 76.
76 days. So what do you say now? What's your comment? What's the general comment? Anyone who wants to comment on this?
I think the payment period reduced from 87 to 75.
Right. So the payment period reduced from that time to that time. What do you think could have transpired? What do you think? What do you think would have led to? What do you think led to the debtors start paying you early? What are the possible situations?
Maybe introduction of discounts.
Okay. Right. So there is that issue of introduction of the discount for early payments. And what else? Also the interest on late payment. Okay. Interest on late payment. Yeah. The interest on late what? Late payment. For those who pay late, when you say those who delay to pay us, we're going to charge you an interest. You get the point? So people, if you put a lot of interest for those people to pay late, so they will try to make sure that they run away from the interest. And for that reason, they will try by all the means to pay you as early as possible. Does that make sense? All right. Messi, how are you? I'm glad to receive you in class. Are you able to hear us?
Yes, I'm able to hear you. Thank you.
Okay. You're welcome in class. Please feel free and ask questions where you are not clear. These are very good people, and it's a good class indeed.
Thank
All right.
you.
We go ahead to the next question. Not the next question. The other ratio that we are calculating is what has happened now? Okay. The payables period. The payables period. How do we calculate the payables period? The payables period. How do you find the payables period? What did we say? Hello?
Is it not payables over sales times 365?
Payables over sales. No. Payables times 365 over what? What's the denominator?
The cost of sales.
The cost of sales or purchases, right? The cost of what? Of sales. If you don't have the purchases, then you can use the cost of sales because sometimes we know that the purchases are usually in the cost of sales. So that is how we go about this one. In 2017, what do we have as payables?
7,900.
7,009 over the cost of sales.
25,772.
774 multiplied by 365 days. And what do you get? What do you get as the days? How many days are these? Hello, how
112.
112.
112, okay.
That's a lot of days, right? 112 days. That's 2017. What about in 2018? In 2018, what was the level of payables? 80,000, right? The cost of sales, 28,256. All that multiplied by 365. And what do we get?
103.
103
3.
days. First of all, what does the payables period measure? Anyone? The payables period measure what?
It measures the payment. How long we are taking to pay our supplier.
Yeah. So like now, what would be your interpretation? What would be your comment on these ratios?
So as a businessman, the longer I take, the longer I make profit. But on the outside, it's not good. It's good you pay in, I think you pay on time so that they give you another goods. So in this
Yeah.
one, from 2017 to 2018, there was an improvement of about 9 to 10 days.
Yeah. Wow. So that is it. So this one measures how long it takes for you to set your accounts. So in 2017, it would take you on average 112 days. That's a lot of time. And then You improved a bit. In 2018, you're only taking 103 days on average, but still, this is a lot of time. So ideally, in business, it's a good thing to balance, right? Don't pay too early, and again, don't pay too late. Especially don't pay too late. Make sure you stay within the stipulated times, because the suppliers will give you the conditions. What they'll tell you is that if you make, for example, payments within 10 days from now, let's say the credit is 30 days from day 1 to day 30, right? If you pay 10 days, within 10 days, we'll give you, let's say, 5% discount, right? That is called the, yeah, that's the discount, the cash discount. We're going to give you the discount. But otherwise, pay within what? 30 days. I'm sure you're following the reading of the statement. This debt has a duration of 30 days. If you can manage to pay within 10 days, we'll give you 5% cash discount. Otherwise, pay within what? 30 days. As a good business manager of finances, you have to calculate the cost. Okay, it is not wrong for you to pay within this range here, as long as you have what to use the money for. You have to weigh the costs. Okay, compare. If this 5% here, when you check, you have no project to invest this money so that this money can multiply, right? It is better you just go for the discount. It's better you pay within 30 days. Unlike you just hold on to people's money and you're keeping the money, you're not using their money to do anything. You are losing out, you get. It's better you just go for the 5% discount. But if you have other serious projects to run, it's better like other serious projects that can yield more return than the 5% discount. Then it's better you pay within what? Within this region. Within 10 days, between 10 and 30 days. It would be nice of you to pay somewhere around on the 29th or 28th day. Right. Because you are still within the agreed time. But not, the suppliers are tired of coming to you, making calls. You're not even picking up the calls. Don't be such a bad debtor. Life is life is like a demand curve. You have to be careful. Okay. All right. Then inventory period. How do we calculate the inventory period? Hello? How do you calculate the inventory period? The inventory period. Hello? How do we find the inventory days? I know it should be inventory times 365 of what? What's the denominator?
Sales, sir.
Right. The sales. The sales or the purchases? Is it the sales or the purchases?
Oh, purchases.
Now I'm finding out. I'm finding out from you. What is the formula to find the inventory days? It's out of the purchases, the sales, right? The total inventory that you have out of what you have sold, the fraction, right? Because it's either you sell or you keep as the inventory. So the inventory over the sales times 365. What is our inventory in 2017? $3,100 to be divided by the revenue of 68,000. All that multiplied by 365 days. What do we get as the days? Hello? How many are these days? People are tired. Oh, I'm logged out. Which one is which now? Don't worry, you'll be fine. We'll be ending. But let's finish the question. Can't just end like this, you know? How many days are these? None of us has a calculator.
We have found 16.6. 16, which
So-
is 7.
17 days.
Yes.
Okay. What about in 2018? Inventory 3,000 over the revenue of 74,521 times 365 days. So how many days are these?
15 days, sir.
It is 15 days.
Yes.
At least the days reduced a bit. So what does the inventory days measure? What does the ratio measure?
Excuse me, you're not audible. I can't hear you on my end. Is it just me?
Basta, your mic is off.
I thought it's just me.
Almost everyone.
Oh, the mic had been muted. Can you hear me now?
Yes.
Oh, sorry, the mic had muted. So I was saying that, so it means I have to start a bit afresh, but I'll be quick. But you heard what I said about the market efficiency, that the market efficiency in general is a type of a market. An efficient market is that one where the prices of the securities that are bought and those that are sold, they reflect the relevant information that is available to the buyers and sellers. So the information is actually symmetric. That is to say, what the buyers know and what the sellers know is equal. So there are no problems of moral hazards. That is in an efficient market. There is no individual who is dominating the market, and usually the transaction costs of buying and selling those securities are low, okay? By securities, we mean the shares, okay? There are also government securities. Those would include things like government securities. The bonds, what are the treasury bills? Yeah, that is what we are trying to say. So generally, that is a market, like an efficient market. Now, the market efficiency is divided into 3 degrees or 3 types. There is what is known as the weak form, the semi-strong form, and the strong form. So I was on a part where I wanted to start with the weak form. Like what qualifies the type of the market efficiency to be weak? What about the weak market efficiency? The weak one. Right. Now, from what I've just said, you know, the weak form hypothesis of a market efficiency, it does explain the changes in share price, usually as a result of the new information which becomes available to investors. As investors get new information, the share prices change. Now, with weak form, this is what happens. The share prices only change when new information about a company and its profits become available. So the share prices do not change in anticipation of the new information being announced, no. But usually the share prices change because of the new information that has become available. So usually in the weak form, you see the following. The share price changes are usually random, okay? That is in the weak form. The share prices, they change randomly. You cannot, you can't trace, you know, they just change because information, they follow the information, and usually immediately the new information comes, there are just those swings. That's the weak form. In the weak form of the market efficiency, what happens is that there is actually no connection between the past price movement and the new price changes. Like you can't draw a line, a straight line. You can't connect how prices are moving. of these shares and these securities, they are just swinging. You get, you can't establish a pattern. They don't follow any trend. Okay, the movement of prices don't follow any trend. That is in the weak form. What about in the semi-strong form? Okay, so under the same strong form, what happens is that all relevant information about past price movement and their implications, they are reflected in the price, of course, the share prices. All knowledge which is available publicly is reflected in the share price. That is in the semi-strong form. But in the strong form, the one that we would desire to have, this is where all the information that is reflected in the price indicate that, indicate that there is a relationship, okay, or reflect the information available from the past price changes. Let me say it like that. Let me say it in that way. That in the strong form efficiency, the share price reflects all the information that is available from the past price changes. The information are available from the public knowledge, the information available from the anticipation, including that information that is known from the insiders. There is just that information which is just known by those people who are inside the system, but others outside the system may not know that information. If the market is very strong, okay, is strongly efficient, is strong or is efficiently strong, what happens is that immediately any simple change happens, whether that simple change is just known by the insiders, even people who are outside will know. In short, there is no secret in terms of information. There is nothing that is hidden. All the information is just public in the market efficiency. Whatever happens, like in the strong market efficiency, whatever happens, whether inside the company, either among the executives or what, everyone knows. There is no one who doesn't know what is going on. Usually the information is available to the public. That is when we say the market is very strong. It does really have a lot of impact on the market share price, because the share prices will only change according to the level of information that has been made available to the public. Right.